Very good day to everybody. My name is Christopher Ng Chung. I'm the trainer for the Early Retirement Masterclass under Dr. Wealth. Today I'll be talking about part 5 of the Death of the Singapore Dream. In part 4, we've spoken about building satellite portfolios using dividend stocks. And so in part 5, I'll be sharing with everybody a framework on how we can build a satellite portfolio using growth stocks, right? And basically what we are trying to do is that we're going to try to use growth stocks to complement our dividend stocks. The dividend stocks generally have the ability to generate income for you, but the large part of capital gains, right, will generally come from growth stocks that are innovative and are able to make massive disruptive changes into the economic landscape. All right, and as a general reminder, I would like to say that these are both satellite portfolio investments, so they should be kept around 20% of your overall portfolio size. Okay, and so for today, we'll be talking about the motivation behind growth stocks, and then I'll be sharing with everybody 2 general approaches on how to look for growth stocks to add to your portfolio. The first, where we'll be screening for growth, right, using a tool, and we'll be talking about following the news, all right, to be able to get growth counters. So let's begin by talking about the motivation for growth, all right? And if you want to look at how the economy works, right, it's almost like a pendulum. It shifts between growth and value stocks, right, value or dividend stocks. So for the past decade or so, the advantage has always been towards growth stocks. As interest rates were kept unnaturally low, you find that companies that are innovative like Tesla, like Facebook, and they've done very, very well, right? These internet companies. But recently you find that suddenly the party has stopped for these technology companies because interest rates are now very high, and it is a lot more expensive to justify these crazy out-of-the-box kind of ideas. And so you find that CFOs in general are now a lot more conservative, given that you get better interest rates when you invest your own company funds into a fixed deposit, for example. All right. So right now, I think dividend investment portfolios are riding high. But of course, I think the general approach is that if you're doing quite well in the markets, right, with your strategy, you should be thinking about what's next, right? And when growth were to come back in the future, there will be another opportunity for you to ride that kind of fantastic growth that we've had, all right, 1 decade ago. Okay, so that's generally the motivation for growth stocks. Okay, the era of growth stocks has more or less ended. Dividends is winning right now, but as we are winning, we are humble. We know that this is not sustainable. One day growth will come back. And so what are we going to do when growth investing does come back? Okay, all right. So once again, let us zoom into the different parts of the market cycle. You find that in the red box, the low volatility, dividend yield, profitability, and value factors are doing very well right now in the downturn. Right, as we anticipate the recovery, which is the next phase, you find that the high market beta, small cap counters, and value will continue to allow outperformance to take place. Okay, yeah. When will the downturn become a recovery? That is $1 million question, and that a lot of us are unable to answer that right now. But we do know that if we were to take a little bit of our earnings from our dividend portfolios and channel it into our growth counters, eventually we will be able to enjoy an upturn. All right, so that's generally the game that we're trying to play. Okay, so if you look at the downturn row right here at the bottom of the slide, you find that dividend yields generally would do better than the other strategies. But in the recovery phase, we really want to look at high market beta, value, as well as small cap counters for us to transition. Okay, so growth does better when markets are expanding, and dividends do better when markets are on a downturn. Okay, now with this in mind, let us now move on to our first strategy when we're looking for growth stocks. And the first is very simple, is to follow the news. So the advice I have for Singapore investors is you should subscribe to the Business Times, The Business Times is a business daily that actually condenses all the business news in a very, very compact kind of format so that as you read it, you will know exactly what is going on in the Singapore markets. And so if you read the Business Times, over time you realize that a lot of investment ideas can be found, all right? And you don't need to like refer to a screener, and you can just explore a particular company that you like and see whether it suits your portfolio's needs. So one of the articles that I have recently has a headline that looks like this, okay? AEM expects record year as the first half profit jumps 183.3% to $82.8 million, all right? So if you look at a attention-grabbing headline like this, there is a potential that this could be the kind of growth counter that you're looking at. So you can take AEM and you can do a little bit of Googling, and you find that there are some analyst reports that are available at DBS Treasures. But the first step when we actually want to buy a company is to go to the SGX website. We at least know that the current price is $4.65. And for me, because I love dividends a lot, I just want to make sure that the company pays a token dividend sum to the shareholders every year. And I find that it's been paying a dividend this year in May and last year in September. So it does pass my very general kind of test, right, to see whether this is something that is worth having in your portfolio. Then you begin to dig in, right? You find out what does AEM do. AEM is a solutions provider for the back-end testing of semiconductor manufacturing process. It works closely with key customers, Intel, right, which is a great stock to have as well, all right, to design, engineer, and manufacture the test handlers. All right, AEM then provides field support and post-sale replacements. Right. So if you look at a profile like this, right, the general idea I have about AEM is that it is a company that sells shovels to miners. So while it doesn't deal directly with semiconductors, right, the people that actually generate or make these chips rely on AEM as a solutions provider for them. Okay, so it should do well when tech is doing well, it should do badly when tech is doing badly. All right. And then we go on to look at some of the financial ratios that they have. The dividend yield, the 5-year average is 2.2. It's nothing to shout about. Okay. The price to earnings ratio is actually not too bad at 14. Okay. And let's see what the analyst report says. All right. The analyst report is found on the DBS Treasures website. Okay. And they say that the highest half-yearly profit before tax is 102 million. Year on year, it's up 187%. So that's really good news. The revenue guidance is revised upwards. There's an acquisition of a smaller company, Nestec, all right, to benefit from higher margin consumables business. And most importantly, your target price is $6, okay, which is significantly higher than the current price. So there is a certain margin of safety, right? If you believe that the analyst is right, the stock is worth $6, you're buying it at $4.65. So there is a certain margin of safety, okay, so that when you buy, you can wait for it to hit the target price, okay? Yeah, so with that said, I think AEM is actually a favorite amongst growth investors in Singapore. So if you are really into growth, right, there's really no harm picking up like 100 or 200 shares, okay? Keep it within $1,000 just to see how the stock would perform over the next few months, all right, which is exactly what I did, and this is something which retail investors can do. Now, moving on, there is a more intense approach, right, to screen for growth stocks. And to do that would be to use specialized software to construct screens, like for example, to set criteria of what kind of stocks that you're looking for. In this particular example, I have chosen revenue growth as my main screen, so I want a high revenue growth over the past 5 years. Because I want companies that generate sustainable cash flow, I always look for free cash flow higher than dividends, all right? And this is something I use whether I'm screening for dividends or growth, right? Because I just want the company to be able to make money but still have some growth potential in the future. And finally, I want a company that has been going up recently, so I use the relative strength indicator and I use it to look for momentum stocks. All right. So you can use any alternative screen, anything with the words increasing profits, increasing operating cash flow. These are all very useful screens to look for growth stocks. I use a software called Stocks Cafe to do my screening, and this is what I've constructed for the screen. All right. Revenue growth 5 years greater than 10%, free cash flow greater than current dividend yield, and the relative strength indicator for the past 21 days to be greater than 50. So with these 3 screens in mind, What the software will do is that it will generate a list of candidates, all right? And right on top of the list, I see this very obscure company called Methanex, all right? And Methanex is interesting because the revenue growth for the past 5 years has been blistering high, right? And it's also seeing quite a number of decent momentum lately. So there is some investor attention being paid to it, all right? But sadly, you don't have a lot of information on Methanex because it's not the kind of counter that you see that's being followed by a lot of analysts, all right? So what do? Okay, we go back to the SGX website. We take note of the current price, which is 24 cents, right? And we go through the various valuation, okay? And right when we look at the valuation, you find that one of the good things that really jump ahead and hit you is that the dividend yield is actually 7%, which makes this growth stock not just a very good growth stock, but it's also a very good dividend yield stock. So I particularly like companies like that, all right? So yeah, and then I perform another test to go to the balance sheet to make sure that the cash flow from operating activities minus off the capital expenditure is higher than the dividends paid, all right? So with all these three things in mind, you've got a stock that's been growing well for the past 5 years. Currently, dividend yields have been very generous, and this generous dividend yield seems to be sustainable by its business practices, okay? So now it's time to find out what the company does, all right? So Methanex is some sort of a medical support services company. When doctors want to set up a clinic, doctors can't just set up a clinic because they're not accountants. So they hire people in Methanex to actually facilitate the setting up of clinics, right? You have to apply for the various licenses, you have to do accounting and taxation. You might even need to hire staff to man your clinics, all right? So they also provide corporate secretarial services, okay? So if you look closely at what the financial statements say, you find that revenue has doubled from 2021 to 2022, okay? But of course, nurses demand a higher salary, all right? The largest source of revenue is medical support services, and dividends have been very regular at 0.84 cents with 2 payouts a year. So management, when you interviewed them, said that, actually they think that the prospects are good because medical tourists are returning, right, especially those from Indonesia, and this can spur new clinic openings, all right? So obviously, for me, when I read this, I'm not really willing to take everything at face value, okay? So what I do is that I would go to Paragon Shopping Centre, I would go to Novena Medical Centre to see whether am I seeing a larger volume of Indonesian patients, and the truth is that I am, all right, because my mom visits a cardiologist in Novena Medical Centre. I'm able to make these observations firsthand. Then I call up my doctor friend and I said that, hey, is it true that with medical tourists that are coming back into Singapore, your friends are leaving the government practice to open up more clinics? And my friend said yes. For the past 3 months, 3 of his friends have actually started and have transitioned into the private sector. So with that, I say that, hey, there's actually really something real that what management is really talking about. So with the amount of research that I've done, which isn't a lot, right, I took a small $1,000 position in a company. And I'll be observing to see whether dividends do arrive in September this year. All right? Yeah, and so that's basically how I would actually look at growth investing. And over time, generally speaking, we can use these two approaches, right, of following the news or using a stock screener to actually find candidates for stocks to add into our growth portfolios. Okay. All right. Now, the next thing I'm going to do is that I'm going to offer you a few more tips on actually how to manage your growth portfolio. Now, the first thing you want to do is that you want to be able to size your position. When you're investing in growth, you realize that there might not be analyst reports, and growth is an extremely unpredictable kind of metric that you will find, because growth can stop suddenly, your market can be disrupted by a competitor, okay, and there can be changes in the market cycle that would render your business not so attractive to other people, right? So when we're investing in a growth stock, we need to really understand that you should never have a growth stock exceed 1% of your net worth, right? You want to size your positions and keep it very small so that it doesn't destroy you if you make an investment mistake. Okay, so the folks in the past who have put all their money into Tesla, right, they might have made a lot of money, but when Tesla drops, right, they would also lose a lot of sleep at night. we don't want to make that kind of mistake, all right? So we limit everything to 1%, okay? So size your portfolios that way, okay? And the other thing that you want to do is that try to keep the total number of growth stocks that you have to a small position in your portfolio, right? So if you're going to keep 1% into a stock like Medinex, into AEM, maybe you should only have 5 growth stocks for you to watch over, right? Because potentially, you know, a mistake can be made for a particular quarter and you might start losing money, all right? So this way, it keeps the damage done to your overall net worth really small, but you can continue to enjoy looking at the growth of your company and watching some of your investment ideas bear fruit, okay? The second tip that I want you guys to consider is to use dollar cost averaging, right? To slowly buy into a counter over time. So if you have $10,000 to be allocated into Medinex, for example, you might want to buy $1,000 every month until all $10,000 is being fully invested, all right? The reason is that these growth stocks can be very volatile. And if you experience a lot of volatility, right, buying it over time allows you to buy the stock at its low, right? There'll always be a low within the next 10 months, for example. So this is something that you can do to also minimize the risk. And finally, growth stocks can make you very humble very quickly. So you should have an exit plan. If your position drops by 30%, you need to get out of the growth counter. And if you actually double your money because the value has gone by 100%, you might want to take out your capital and assign it somewhere else. It can be another growth stock, it can be a dividend stock, it can even go back to your core portfolio, right? But when it comes to growth, always have an exit plan, okay? And anything can happen, all right? So growth is not something which is that you can really predict, right, over a long period of time, okay? And finally, not everybody is suited for this form of growth investing. All right. Fortunately for investors, there are exchange-traded funds that allow you to benefit from a return of the tech industry that might happen over a certain number of years in the future. So, for example, I invest in the following. I like the iShares Hang Seng Tech ETF 3067. It is a proxy for the tech industry in Asia. It owns stocks like Alibaba, okay, but it's lost about 45% since last year. All right, so you could be buying basically a portfolio of battered tech stocks, and you're hoping that a recovery will happen, right? I think the first thing that needs to happen before a recovery is China abandoning the zero COVID policy. So that would be a very good big plus for this ETF if it happens in the future. The second ETF that I own is the iShares Exponential Technologies ETF, code is XT, and it focuses on innovative companies in the US. It owns companies in the medical sector like Eli Lilly, used to own a lot of Tesla, but now it has sort of pared down that position. It is not as dramatic as a fund like ARC Innovations, and actually didn't lose a lot of money since last year. All right, it's promoted by this guy called Rick Edelman in his book The Truth About Money. I strongly recommend his writings. He's a very down-to-earth kind of financial advisor in the US. All right, so if you think that owning individual growth stocks is a little bit too stressful, then you can consider these ETFs instead. All right. Okay, and so with that, we've come to the end of our presentation. Growth investing taps into our desire to make speculative bets. And we don't try to suppress that desire in our investment journey because it can lead to very high capital gains if we time the markets correctly. The risk and reward for each investment can be very high, okay? And this tends to do better when the economy is in a recovery or expansion mode, right? You find that there are decent growth stocks in the Singapore Stock Exchange. If you were to follow the news carefully, even though we're not really a market for growth stocks, okay? Now, finally, when buying growth stocks, be humble. The odds of making a mistake is very high, so you should do a little bit of position sizing, do some dollar cost averaging, and have a viable exit plan, all right, to complement your investment in this particular area. And with that, we've come to the end of part 5 of the Death of the Singapore Dream. We will be concluding this series in part 6, where we will talk about the new Singapore Dream, which is a summary of everything that we've done so far, and what are the steps you can do to begin living your new Singapore Dream right now. All right, so I look forward to seeing you in about a week's time, okay, where we'll launch the final section in this series. Okay, thank you very much. Goodbye.